Welcome, everybody. And for those of you who may be jumping on at this exact second, please don't be shy about introducing yourself when you get here. It's my pleasure today to be doing our first presentation ever on the relationship between ESOPs and the charitable pay raise. And no one better to help guide a bunch of us through the basics on ESOPs than Mary McCooe. And Mary practices, she's a principal up in Boston with, I'm looking at Maselan and Jones, and for 11 years has been working in the ESOP issues, business succession area. And as I found out in inviting people to this presentation, she has relationships with a whole bunch of you all, which is great. So Mary and I discussed the format for today, and because it's a pretty small group, we're okay answering some questions as we roll along. And what I asked Mary to do was to walk us through some of the basics for the people like myself as a planner and Mark Kluge and others on here, and show us and other people that are going to be popping on some of the basics and in the world of ESOP. And then we will talk about how the charitable pay raise can be a wonderful exit strategy for ESOPs when the situation is right. So with no further ado, it's my pleasure to introduce Mary McCooe. And in Mary's background, as I was looking through here, Mary, I think you're the first person I've ever met who graduated from the University of Alaska. So
I get that a lot.
You're unique to begin with. So all good things. Please take it from here.
All right. And I don't think I have control of the slide, so Jen, I'll let you know when I'm ready to move forward. So yeah, we can go ahead and get started. Thank you, Bill, for the introduction. It's great to be here today. Great to be talking about ESOPs, my favorite topic. So Bill asked me to kind of start out today to talk a little bit about the history of ESOPs. Even though ESOPs are something that a lot of people, I think, the general public are not familiar with, they've never heard of or have very limited knowledge of what an ESOP is, they've actually been around for quite a while. San Francisco lawyer and economist Louis Kelso is credited with creating the first employee stock ownership plan, or ESOP, back in 1956. And he did it as a way to transition ownership of Peninsula Newspapers, Inc. from its two founders, who were both in their 80s at the time, to their chosen successors, which were the managers and employees of the company. The founders really didn't want to see their company sold to a third party or to a competitor. They cared a lot about their employees. They wanted to preserve jobs, but they knew, they were reaching retirement age and needed to plan for their exit. So Louis Kelso developed this fantastic idea of using an ESOP as part of their exit strategy. Now, at this time, having the ESOP borrow money to purchase employer stock was a prohibited transaction. So the code permitted companies to go to the IRS and seek an exemption from the prohibited transaction rules on a case-by-case basis. And that's what Louis Kelso did here. He went to the IRS and sought specific permission to form this ESOP for Peninsula Newspapers. And that's how ESOPs were created for a while. Each transaction had to be specifically approved by the IRS. Then, due to the efforts of Senator Long, the Employee Retirement Income Security Act of 1974, or ERISA, defined ESOPs and actually included a prohibited transaction exemption for ESOPs to allow us to use ESOPs the way we do today. So now companies do not have to go to the IRS and seek specific approval for an ESOP transaction. There's been a lot of subsequent legislation and tax incentives to promote ESOPs. And the history is really long, way more time than we have to go through today. They've been used for a lot of different purposes, but right now we're seeing them used for the exact purposes Peninsula Newspapers first used their ESOP for. And it's really to use it as a business succession tool to preserve employee jobs, to create strong retirement benefits, and ultimately to narrow the wealth gap in the United States. So, what is an ESOP? Well, at its core, an ESOP is a qualified retirement plan. So a lot like a 401k plan or a profit sharing plan that you may be familiar with. two key features of an ESOP that really distinguish it from another qualified retirement plan. First is that the ESOP is intended to be invested primarily in company stock. So it is designed that it can be 100% invested in the stock of the company that sponsors it. And the second feature is that the ESOP is actually permitted to borrow money to acquire the stock. ESOPs they're highly regulated by the IRS and the Department of Labor, so they do undergo a lot of scrutiny, but as long as you're working with experienced professionals, that should not pose an issue. They are also, in the space where I practice it with private companies, they are company-funded benefits. So employees are not using their own money to purchase the stock. And that's probably one of the biggest misconceptions about ESOPs I see out there. In the private company space, generally every ESOP is going to be funded by company contributions and not by the employees and their own money. Finally, it's worth noting that the ESOP, when the ESOP acquires shares of the company, it becomes a shareholder of the company. The ESOP or the ESOP trust is a shareholder. So the employees don't directly hold title to shares. If you have a 200 employee company, you don't all of a sudden have 200 shareholders in the company. But the participants, the employees, become beneficial owners of the ESOP. So they have a beneficial interest in the stock that is held in the ESOP trust. So also, Bill wanted me to kind of walk through an example ESOP transaction today. And this is probably the most difficult thing to explain to business owners. It usually takes several conversations before you understand. And part of that is because every ESOP is a little bit different. Every ESOP transaction is a little bit different. And it's probably a separate hour-long presentation to talk about the reasons for all of the differences. But I'm going to try to walk us through this example, and please chime in if you have questions, if you want me to stop and slow down and re-explain something. But in this example, I'm going to use some hypothetical numbers here. So we're going to say we have this one company here that wants to become a 100% ESOP owned company. And everyone's agreed the value of the company is $10 million. The business owners, maybe there are two owners, they're looking to sell all of their stock to an ESOP for the benefit of their employees. So one way this transaction may be structured is to have the company go to a bank and say, hey, we're looking to form an ESOP. We would like to borrow some money so we can, so we can establish an ESOP and buy out the current shareholders of the company. So in this example, let's say the bank agrees to lend the company $3 million for the purpose of facilitating the ESOP transaction. In step one here, you see the company, maybe writing a promissory note to the bank, and the bank providing in step two, $3 million of cash to the company. The company can then use this $3 million in cash, and it can loan it to the ESOP trust. In return, the ESOP trust issues the company a promissory note saying, we promise to pay you this $3 million in cash that you lent us. And as security for this loan, we're going to pledge the shares of the ESOP pledge the shares of the company that we are purchasing with this $3 million. So that's what you see in steps 3 and 4 there. Now, we said at the beginning, this company is worth $10 million. So that $3 million loan from the bank wasn't enough to fund 100% of the transaction. So in steps 5 and 6 here, we see that the company has agreed to redeem from the business owners the remaining shares of stock. So the $7 million of stock that the ESOP did not purchase, the company is going to redeem those shares. It retires them. They go into treasury. They're no longer outstanding shares. So in step 5 here, you see the company providing the sellers with a promissory note totaling $7 million, and the sellers providing the $7 million worth of stock back to the company. And 7 and 8 here again, so where the company had lent the ESOP the $3 million, the ESOP in step 7 is using that $3 million. In step 8, it's using the $3 million to provide the business owners with cash, and the business owners in step 7 there are providing the stock. So the numbers on these steps aren't necessarily meant to show an order. They're just used to help kind of identify them as we walk through. Does that part make sense to everybody? Does anybody have any questions there? With all the separate transactions, it's kind of a lot, but if we turn to the next slide, I can kind of help show the end result that we'll typically see regardless of how the transaction is structured. So on this slide, you see there's a loan between the company and the bank. there's a loan between the company and the sellers. So the company owes the bank money, the company owes the sellers money, and then there's a separate loan between the company and the ESOP. And this is commonly referred to as an ESOP loan or an inside loan, an internal loan. And this loan between the company and the ESOP is what provides the participants with their benefit levels. It's as this loan gets paid off that the shares the ESOP purchase get allocated to the individual employee participants of the company. So the company will go ahead and make cash contributions into the ESOP. The ESOP trustee then takes that cash and returns it right back to the company as a payment on that $3 million loan it took. And then those shares that are now paid for get allocated to the eligible employee participants. So at the end of the day, you've got these 3 separate notes. The repayment, typically a bank is going to get repaid first, then your sellers are going to get repaid. And the repayment of the bank and the sellers is really separate from the repayment of the ESOP shares. We'll go along to the next one unless anyone has any questions there. All right, so quickly here just to talk about how the employees benefit. So just like any qualified retirement plan, the employees need to be eligible to become participants in the ESOP. The IRS says that the maximum eligibility requirements can be age 21 in 1 year of service. A company could allow you to begin participating at age 18 or 19 or 20 or sooner, but age 21 is that outer limit there. And then once you are eligible to become a participant in the ESOP, you start to receive allocations. So as the company makes contributions to the ESOP, as that loan gets repaid, you're going to get allocations of those shares into your ESOP account. Most ESOPs are going to allocate the shares on the basis of compensation. So you'll get, your compensation relative to the total compensation of all participants, you'll get that proportion of the shares that are released each year. There are other formulas out there though, so that is not always the case. And then vesting, so you have to, oh, yep, okay, so but Bill asked me to speak to the value of the company after loans and going forward. So the, that's an important point. So if you do 100% leveraged ESOP transaction, the company has taken on a lot of debt to fund the transaction. So our $10 million company that just took on $10 million of debt is not going to have a very high value. So immediately after the transaction, you're going to see a very low value per share. And as the debt gets paid off and the company continues to do well and to grow and be profitable, then the value of those shares is going to grow from each year. So each year participants are getting allocations in their ESOP account. So they're getting more shares in their ESOP account, and they're also sharing in the hopeful growth of those ESOP shares. So as those shares grow in value, their account becomes bigger, both as a result of the increased value of the company and also the increase of shares in their account. Vesting, again, just like a profit sharing plan or 401k plan, you can have vesting provisions in the ESOP. The maximum is going to be a 6-year graded vesting schedule. So an employee could become 20% vested after year 2, 40% after year 3, all the way up to 100% after year 6. Or it could be a 3-year cliff vesting schedule where they're 0% vested until year 3 when they become 100% vested. We got a question here. Are annual contributions guaranteed or determined by someone as part of compensation? So the contributions typically in the transaction where the ESOP is taking the loan, the company will make a commitment to fund the ESOP with the contributions necessary or sufficient to repay that loan. So nothing is guaranteed to the employee, but the company is making a commitment to make those contributions to enable the ESOP to repay that loan. And then finally, in step 4 here, we see distribution. So getting cash or shares from your ESOP account. And again, the ESOP is a qualified retirement plan. So generally, you're not going to see a plan where employees can just take money or shares out of it whenever they want to. They're going to be getting or eligible for distributions upon death, disability, or termination of employment. The rules are specific, set forth in a summary plan description and plan document for each ESOP. So these are kind of some generic provisions, but of course, if you are looking at an ESOP, you want to look at the specific rules for your plan. But the most interesting point here is that the distribution from the ESOP can be either in cash or it could be in stock. And so Bill is going to talk to us a little bit today about, what happens if that distribution is in stock? What might you be able to do with it, Bill?
Go ahead, Bill, you're good.
Can you hear me?
Yes, we can hear you.
Okay, I'm looking at my picture and it's got the wonderful red microphone blocking my my microphone. So anyway, Mary, thank you very, very much. That was an excellent overview. And it's a pleasure to talk to you about the charitable pay raise and why it's such a good partner for the world of ESOP. And a lot of this goes back to the change in tax law under the Tax Cuts and Jobs Act, which became law on 1/1/2018. And at that time, go ahead, Jen. Just a quick overview from the participant side of receiving ESOPs and information that was introduced to me in preparation for this presentation. As Mary mentioned, just like a 401k or profit sharing, but also similar to a defined benefit plan, I think it's the most similar plan because it's funded by the employer as opposed to co-funded in a 401k. But the point is here, there's a lot of incentive for the employees because as they grow the company, work hard, and improve the fortunes for themselves, they're improving it for everybody else in the plan. So you've got quite a strong incentive from day one to help the company grow. Studies show that ESOP companies grow about 2.5 times as fast as non-ESOP companies, and they provide 2.2 times normally the amount of retirement assets. So all great things. Next slide, please. So TCP, the charitable pay raise, we think is the best exit from the ESOP for participants who are in desire to maximize really their retirement cash flow from the vehicle. And we're going to walk through how we can accomplish that in a moment. So the shares that Mary just mentioned, as I think everybody here probably knows, go by the nickname of NUA, which stands for Net Unrealized Appreciation. And essentially, this can be in the ESOP, as we've been discussing today, but also possibly in a 401k plan as well. And in the middle here, you see that when a person extracts the shares from a retirement plan, an ESOP or a 401k, the value of those shares is going to, the basis is going to be taxed as ordinary income in the year that they do that. And if they take out one share, they must take out all the shares to receive NUA tax treatment. And what was really significant in the Tax Cuts and Jobs Act was that it changed the treatment of these shares such that it allowed for the sale of shares in year one to cover the tax burden due, number one, and those shares, the growth on those shares was given immediate capital gains treatment as opposed to having to wait a year, as was the old law. And it dawned on me that these facts, in tandem with a strategy that some of you may have heard of, it's gone by different names, such as a charitable LLC or a philanthropic LLC. If we took some of those concepts and rebuilt that in, I think, a stronger way, and with the help of 8 different attorneys and Stuart Analik, who's on the Zoom, we came out with a construct in the form of an LLC that helps the client really maximize the enjoyment of those shares. And I'm glad Mary spoke to the fact that in the beginning of the ESOP, the shares that these participants are receiving have zero or very, very low basis. But over time, as the company becomes more valuable, so too do those shares. So obviously, you've got a lot of capital growth that's occurring inside the ESOP over the years. And for somebody who's worked 20, 25, 30 years, as many of you have experienced with clients, plans you're running, et cetera, you've got a heck of a lot of appreciation on those shares. And unfortunately, heretofore, go ahead, Jen. What most folks do is what you're looking at on the slide right now. Traditionally, we see people sell their shares, roll the cash over into an IRA, reinvest it, and then down the road in one form or another, even if it's RMDs, they're going to be taking that money out, and it's going to come out in the form of taxable income. And that's what 99.9% of people do, unfortunately, and they lose an opportunity to take advantage of the special tax laws on those newest shares. So what we do is as follows. Rather than doing what you saw up top in the light green, what we do is we just open up a standard individual brokerage account in the Social Security number of the participant. Nothing new. Then we take advantage of the new law and we pull out all their shares and deposit them into the brokerage account. And we've triggered ordinary income tax will be due on the basis of those shares because they've never been taxed. They've always been inside the plan. So let's say it's $1 million of fair market value with a basis of $300,000. So our participant is going to owe tax on that $300,000 in the year for the year in which they've done this. Now, that's day one. Now, day two, we can take those shares, either all or in part. And I want to emphasize that it's not an all or nothing solution. You may have a client who's been dreaming of, like Mark Kluge, having a hunting camp up in the Adirondacks, and he wants to carve out $250,000 to go buy, a hunting camp up there. You can do it, no problem. But we're going to take whatever portion of the shares or all of them that next day, and we're going to move them into a single member LLC with its own tax identification number, but owned completely by our client, the participant, the retiree. So now we've moved our company shares, be they private or public, into the LLC, which has its own brokerage account for these shares to reside. Nothing has happened to the employer stock yet. It's still sitting there. And it's at this point that the magic happens. And I think the biggest element in the quote magic is that we're going to update and restate the operating agreement at this point. And we're going to create two different classes of units, much the same way we used to do family limited partnerships. Same concept. We're going to have 1% controlling voting managerial units, and 99% will be common non-voting units with all the usual hindrances, if you will, non-transferable, non-marketable, illiquid. There's one exception, and I'll speak to that in a little bit, but it's mostly designed just as a fail-safe. But at any rate, we now take those 99% non-voting common shares and we gift them to the charity or donor advised fund of our choice. And as we know, whenever we give something away to charity and they accept it formally, we're going to get a deduction. So this is where the valuation folks like Empire and others will come into the act, and they will value the 99% ownership, the units that are given to the nonprofit to determine the value of that gift. And thus far in working with clients, the valuations have always come in at around 80% of the actual value of the shares that were put into the LLC to begin with. So in my example of $1 million, we're going to have an $800,000 charitable tax deduction as a result of giving those units to St. Jude's Hospital, we'll say. So now they have an ownership position, which they have accepted in writing. They've become a member of the LLC. We now have an LLC filing a tax return as a partnership at the end of the year, and it will have 2 K1s. And at this point, we can go ahead and sell the shares. And we don't want to have a concentrated position, or there may be rules affecting us that we need to sell those shares anyway. So we sell those shares for cash. And now we have a $700,000 capital gain. And at the end of the year, when the tax return is done, we will have 99% of the capital gain, 693,000 in my example, will be on the K1 that goes to St. Jude's, and $7,000, 1% of the gain, going to our client, the participant, retiree, manager, donor, etc., all those titles. So our client's going to end up owing tax, capital gains tax, federal and state, depending, on 7,000, and St. Jude's doesn't pay tax. So they will pay zero tax on their portion of the capital gain. I want to speak to the use at this point, too, of that $800,000 charitable deduction, because as we mentioned at the outset, we're going to owe ordinary income tax on $300,000. Well, we're going to carve out $300,000 of that charitable deduction to abolish the taxation on the basis that we owed. So we've wiped it out completely, and we still have $500,000 of charitable deduction to go. And Jen, go ahead and hit the button. And with that 500,000, whenever we can, we encourage the client to take other pre-tax money and use it to do a Roth conversion. So from year one going forward in our LLC, we're mandating that the retiree manager is going to send distributions to their charitable partner every year for the rest of their life and that of their spouse. And it's 1% or greater of the corpus, and that's mandatory. So we've got immediate economic substance. And after 2 years, the client and their spouse, if they wish, are allowed to start taking money from the LLC, and they're going to do so in the form of loans at 1.1 times the long-term applicable federal rate. So we've got a bona fide loan, and this is the way it's going to be for the rest of the client's life. So at the end of the day, they will be getting loans which are tax-free cash flow from the LLC, the Charitable Payraise LLC. They're going to be getting tax-free cash flow from their Roth, hopefully, and hopefully will even reduce the tax bracket on the remainder of income that they'll be taxed on, like Social Security and pensions and things like that. And finally, upon death, the charity is going to receive the 1% managerial units, so they'll own the whole thing, and the loans and interest will be paid back, often using a life insurance construct, but the loans and interest will be paid back to the LLC, as well as whatever the remaining investment portfolio that's in there, and it will all pass to the charity at that time, leaving a legacy gift. Next slide. Here's an example of Mary. You can see the numbers. She's got $1 million of shares and 2 million in other funds in her 401k. Next slide. And here's the way, with Mary's assumptions, not ours, that the numbers play out when you compare the traditional way of, as I showed you previously, putting everything to cash, reinvesting it, and taking it out. And on an after-tax basis, it would be $142,000 a year versus using what you just saw, where it's almost $184,000 a year, giving us almost a $42,000 improvement. Over Mary's expected 27-year life expectancy, we're improving her personal economy by almost $1 million. And at the same time, those 1% distributions are going to go, creating almost $270,000 of planned gift for a charity. And then between the repayment of the loans, the remainder of the money left in the LLC account, and the 1% managerial units, Mary's making a $3.3 million charitable bequest. And that's a whole different ballgame in philanthropy. Next slide. Mary, do you want to talk about these for a second?
Wasn't sure if you were talking about your hypothetical Mary here or not. So summary of the ESOP benefits for an owner. There are a lot of benefits out there to owners of companies looking at looking at business succession options. So one of the key ones is that it's a controlled exit strategy, right? As a business owner, you can choose when to establish an ESOP. You can choose when and how much to sell to an ESOP. So you don't have to sell 100% of your shares to an ESOP right away. You could maybe start with a 30% transaction, then move up to a 50% transaction, and finally sell the remaining, the balance of the shares you own. It's a built-in market for selling the business. So again, you're creating the company. You're creating the buyer of your shares. You don't have to go find an existing third-party buyer. It's a way to leave a legacy and ensure the business survives even after retirement. That is something we find is pretty important to a lot of our business owners. They really, that they care about their employees a lot, and they care about the business. It's family to them, and they really want to make sure it survives after they retire. Deferment of capital gains tax, that is also a great incentive for going to an ESOP. A lot of our clients are very interested in some of the tax benefits that go along with establishing an ESOP. So if you have a C corporation and you're selling shares of your C corporation to an ESOP, you may be able to elect under Code Section 1042 to defer capital gains tax on all of the sales proceeds. Increase in personal liquidity, but still retain control of the company. So again, this is all the flexibility that an ESOP provides. You can say, I'm not ready to give up control of the company. I'm only going to sell 40% of my shares right now. So we can share something with the employees and allow them to benefit in the growth of the company, but I can still retain control of the company. Greater employee loyalty and improved business productivity. Again, that comes with employees, appreciating this, incredible opportunity they have to share in the growth of the company. I think it's an exceptional benefit, and all the studies show that ESOP-owned companies are providing significantly greater retirement benefits to their employees than to other non-ESOP-owned companies. So you've got loyal employees as a result, and employees who really want to do the right thing by the business, and they are really properly incentivized to grow the business and be productive, because at the end of the day, it impacts their bottom line.
Awesome. And then as they exit, we hope that the charitable pay raise merits consideration, because we can help them obviously work with a larger sum of money by mitigating the capital gains tax on those shares that they've earned over all those years, and eliminating the ordinary income tax on the NUA. So just for starters, in my $1 million example, they're going to be working with, just under the entire $1 million on an after-tax basis. And then from a cash flow standpoint, as you saw in the example, there's considerable improvement to their personal economy for the rest of their life. And we feel it's very important that we're supporting philanthropy. And the beauty here is it's not our choices, it's their choice. So whether they choose one particular charity or a donor advised fund to direct their grants from year to year to year, this is really a powerful thing for a lot of people who want to be philanthropic and always thought that they didn't have the largesse to make a difference. And we find that there are a lot of hardworking folks that have done quite well financially that really enjoyed this aspect. And their name doesn't have to be Bill Gates or Jeff Bezos to do it. So it fits neatly into that niche. So questions? And we open it up to the rest of the group here, Jen?